Hello, I am Kemal Çek. I would like to welcome you all to our first lecture of Accounting 2. Today we will start with Chapter 6 and the topic is Accounting for Merchandising Activities. First of all, let's talk about what's a merchandising company. Merchandising company buys and sells products. The operating cycle of a merchandising company involves three occasions. First of all, we use cash to purchase merchandise and store it as inventory. In the second step, we sell the inventory either on account or as cash. The collection of accounts receivables is the third step of the operating cycle of a merchandising company. If we are to compare the merchandising activities with manufacturing activities, the merchandising company purchases inventory in ready-to-sell condition. Some examples are supermarkets and clothing stores. They purchase the goods in ready-to-sell condition, store them, and then sell it directly to customers. The manufacturing companies manufacture the inventory by themselves and have a longer and more complex operating cycle. Some example includes the aircraft companies such as Boeing, the automobile companies. So basically they manufacture themselves and sell them to either merchandising companies or directly to customers. We will focus on the merchandising companies. There are two types of merchandising companies. The first one is the wholesalers. Wholesalers buy merchandise from several different manufacturers and then sell this merchandise to several retailers. So the wholesalers buy the merchandise in large sums and store it and sell it to the other retailers. However, the retailers sell merchandise directly to public. They are mostly the stores. The income statement of a merchandising company have some differences on the service companies. For example, the first difference is that we have a cost of goods sold. The cost of goods sold represents the expense of goods that are sold to customers. Basically, the cost of goods sold is the price that the company paid for these products. What did the company pay to get these products from the manufacturers? The difference between the revenue from the sales and the cost of goods sold is called gross profit, which is the second new item in our income statement. The gross profit is a useful means of measuring the profitability of sales transactions. There are two approaches in accounting for merchandise transactions. The first one is the most important one for us, is the perpetual inventory system. In this class, we will focus on the perpetual system. And the second one is a more traditional and old method, is called periodic inventory system. Let's talk about them. The perpetual inventory system is a system which continuously updates the items on hand. Basically, they continuously update the amount of inventory, the amount of stock held inside the company. As an example, on September 5th, Worley Co. purchased 100 laser lights for resale for $30 per unit from Electronic City on account. The Worley Co. is a merchandising company. When they purchased 100 laser lights for $30 each, the total inventory will be 3,000. And as they purchase them on account, there is an accounts payable to Electronic City of 3,000 as well. In the next one, the Worley Co. sold 10 laser lights for $50 per unit on account to ABC radios. Basically, the purchase price was $30 and the selling price is $50. As you can see, they are selling this inventory at a higher price in order to make some profit. When they sell them for $50 each, 10 laser lights, the account receivable was 500 and the sales revenue was 500. But when it comes to the decrease of inventory, as we sold 10 laser lights from the inventory, now we need to decrease our inventory by 10 laser lights. And a decrease in inventory will be recorded as cost of goods sold. As you can realize from the slide that when talking about the sales, we use the selling price, which is $50 per unit. But when we talk about a decrease or an increase in inventory and cost of goods sold, we talk about the original price we paid for the products. On the next one, Worlico paid Electronic City $3,000 for the September 5th purchase. When the Worlico paid their accounts payable, they decreased the accounts payable by $3,000, and of course they pay their payables with cash, so we observe a decrease in cash as well. When it comes to the collection of an account receivable, Worlico received $500 from ABC Radios as payment in full for their purchase in September 10th. Remember that we had an accounts receivable from ABC Radios, and now we are collecting it. When we collect the accounts receivable, we observe an increase in the cash and a decrease in the accounts receivable now that we received it. Taking a physical inventory. Companies, in order to ensure the accuracy of their perpetual records, take a complete physical count of the merchandise on hand at least once a year. Companies count their stock, count their inventory at least once a year because sometimes the accounting records may be misleading. Sometimes there may be some thefts, some brokerages, some spoilages. So they need to, in addition to the computerized system, they need to make a physical inventory. They need to count them one by one. Let's see how do we record any shortages when talking about a physical inventory count. Reasonable amounts of inventory shrinkage are viewed as a normal cost of doing the business. Examples include breakage, spoilage, and theft. On December 31st, Worlico counts its inventory, and inventory shortage of 2,000 is discovered. When Worlico counts the inventory physically, they realize that the amount on the accounting records and the actual counted amount is a mismatch. So, and the physical count shows that there is a 2,000 shortage between them. So when we made the physical count, we observe that we have a 2,000 shortage, so we decrease the inventory by 2,000, and as we said, a decrease in inventory is recorded as a cost of goods sold. So we decrease the inventory by 2,000, increase the cost of goods by 2,000. Just to define a periodic inventory system, in the periodic system there is no effort made to keep up-to-date records of either inventory or cost of goods sold. As you realize, in perpetual system, we update the inventory and we update the cost of goods sold after every transaction. But in the periodic system, it's an old type system, mostly used by local small shops. They do not update the inventory on a continuous system. If we are to compare the perpetual and periodic inventory systems, we can say that the perpetual inventory system mostly used by large department stores. the more modern types of organizations. But the periodic inventory system are mostly used as small local shops where they do not have a professional accountant, they might not have a computerized accounting system, so they might prefer to use the periodic inventory system. When we talk about merchandising companies, of course, we need to talk about the discounts and the sales on credit terms. When manufacturers and wholesalers sell their products on account, the credit terms are stated in the invoice. Here we can see a discount code 210 net 30. Let's see what does this means to us. The 2 means the percentage of the discount, and 10 means the number of days the discount is available. So from this one we can understand that we have a 2% discount which is available for 10 days. When the 10 days is over, we will no longer be able to use the discount. And let's continue. Otherwise, the full amount is due in 30 days. So if we missed the 10 days, we missed the 2% discount, and this means that we will pay the full amount in 30 days. We have 2 methods when recording the discount. The first one is the net method. Net method purchases are recorded at their net amounts. Purchase discounts lost are recorded when payment is made outside the discount period. The net method says us to record the transactions with the discounted prices. Let's see. On 6th of July, Playclothes purchased 4,000 of merchandise on credit with terms of 2% available for 10 days, otherwise full amount on 30 days, from Kids Clothes, and prepare the journal entry. As you see, when Playclothes purchased $4,000 of merchandise, they increased their inventory, but with the discounted price. The discount was 2%, so the Playclothes will pay 98% of the discounted price, which is $3,910. So with the net cost method, instead of the full 4,000, we use the discounted price. That's why it's called net method. On 15th of July, Playclothes pays the full amount due to Kids Clothes. So here we can see a payment of accounts payable. Again, when we pay our accounts payable, we decrease the accounts payable with the discounted price, and we also decrease the cash with the discounted price. Now assume that Playclothes waited until 20th of July to pay the amount in full to Kids Clothes. Now we assume that the discount days, 10 days, is passed. So the Playclothes will pay the full amount instead of the discounted amount. Remember, the discounted amount was $3,910 and the full amount was $4,000. As we pass the discounted period, the cash is decreased by $4,000, but we have a purchase discount lost of $80. This is the difference between the full price $4,000 and the discounted price $3,920. We record the purchase discount lost as a non-operating expense. We do this because at the beginning we assume that with this method we get the discount. So that's why from the beginning we started recording with the discounted prices. But at the end, if we miss the discount, this causes a problem for us, so we need to adjust our accounts. So if we miss it, the difference between the paid price, the full price, and the discounted price will be our purchase discount lost, which is an expense. Yes, the second method is the gross method. The gross method, purchases are recorded at their gross amounts, at their full amounts. Purchase discounts taken are recorded when payment is made inside the discount period. Let's see. On 6th of July, Playclothes purchased 4,000 of merchandise on credit with terms of 2% discount for 10 days, otherwise full amount in 30 days from Kids Clothes. So we will apply the same example. As we are using the gross method, we record with full prices. So we increased the inventory by 4,000, increased the accounts payable by 4,000. In the net method, we used the discounted price. But with the gross method, we started recording with the full prices. On July 15th, Playclothes pays the full amount due to Kids Clothes. As you see, in July 15th, the Playclothes catch the discount period. So the accounts payable is decreased by 4,000. However, the cash is decreased by the discounted price, which is 3,920. Why? Because the Playclothes are within the discount period, so they are paying the discounted cash. The difference between the full price and the discounted price in that case will be recorded as a purchase discount taken, which is a reduction in cost of goods sold. Let's continue. Now assume that Playclothes waited until 20th of July to pay the full amount due to Kids Clothes. Now we assume that the Playclothes misses the discount period. So when they miss the discount, of course, they will pay the full price, which is 4,000. Okay, let's now talk about the returns of unsatisfactory merchandise. On 5th of August, Playclothes returns $500 of unsatisfactory merchandise purchased from Kids Clothes on credit terms, 2% for 10 days. The purchase was originally recorded at net cost. So actually Playclothes is not satisfied with the products bought from Kids Clothes, and they decided to make a return. So when they make the return, their accounts payable is decreased by the discounted price, and their inventory is decreased by the discounted price. Let's see how the transactions relating to sales shown in the income statement. The revenue is coming from the sales. Sales are 912,000. But we have some discounts provided and some returns. These total to 12,000. So the net sales revenue is 900,000. So when we talk about the sales revenue, we need to also take into account the sales returns and allowances and the sales discount. Credit terms and merchandise returns affect the amount of revenue earned by the seller. Let's talk about sales returns. On 2nd of August, Kids Clothes sold 2,000 of merchandise to Playclothes on credit terms, again 2% for 10 days. Kids Clothes originally paid 1,000 for the merchandise. Because Kids Clothes use a perpetual inventory system, they must make two entries. So now, when 2,000 of merchandise was sold to Playclothes, there is a 2,000 accounts receivable for the Kids Clothes, and they earned a 2,000 sales revenue. Remember, the original price that Kids Clothes paid for these products was 1,000. So the cost of goods sold is increased by 1,000 and their inventory decreased by 1,000. When Play Clothes returned the $500 of unsatisfactory merchandise to Kids Clothes from the 2nd of August sales, Kids Clothes' original cost for this merchandise was $250. But first of all, when Kids Clothes accepted this Play Clothes, they say that, okay, we will not accept a payment from you. So Kids Clothes decreased their accounts receivable by 500 and increased their sales returns allowances by 500. When Kids Clothes accepted the return of products, of course their inventory will be increased by the original cost of these products, and the cost of goods sold will be decreased. Remember, when they made the sale, they firstly increased the cost of goods sold, decreased the inventory. When they accepted the return, they applied the reverse. They increased the inventory, decreased the cost of goods sold. And let's say another example. On 6th of July, Kids Clothes sold 4,000 of merchandise to Play Clothes on credit with 2% discount. The merchandise originally cost Kids Clothes 2,000. Because Kids Clothes used a perpetual system, they made two entries. Accounts receivable increased by 4,000, sales revenue increased by 4,000. And the cost of goods sold increased by 2,000, inventory decreased by 2,000, which is the original price. On July 15th, the Kids Clothes receives the full amount due from Play Clothes. Basically, the Kids Clothes received the discounted price. So the cash they received is 3,920, and the sales discount they provided was $80, which is a contra revenue, which decreases our revenue, and their accounts receivable decreased by 4,000. Because at the first step, they record their account receivable with the gross method as 4,000. So when they receive the discounted price, they again decrease the account receivable by 4,000. Now assume that it wasn't until 20th of July that Kids Clothes received the full amount due from Play Clothes. Now we assume that the Play Clothes missed the discounted period and Kids Clothes are receiving the cash after the discount period. So they received the full price. So cash is increased by 4,000, accounts receivable decreased by 4,000. This is the end of our slideshow. Thank you for listening. In next lecture we will talk about financial assets.